a lot of people are really down. They're like, I don't want to be investing right now because it just feels like things are so bad. The reality is, this is the bottom. Today's the day to be buying because we're going to look back in 5 years and we're going to wish we bought everything.
All these companies that have lasted 100 plus years were all founded in recession. And then we're complaining about there being a recession.
The reality is we are going to have a recession. I don't know if it's today, 6 months from now, 5 years from now. On average, we have them every 4, 5, 6, 7 years, and we're now overdue by about a decade.
And we're seeing mass layoffs across the board. Yep. We have AI paired with tariffs. Our members that are making $200,000, $300,000 a year, 9 years in a position, all of a sudden it's gone.
There's so many benefits that real estate investors get when it comes to taxes. We haven't paid taxes in 5 years.
If people could understand this, it's literally going to your income and adding 37%.
It is.
To your income. What's some closing advice you would give them in this economy?
We know what's going to happen 5 years from now, 7 years from now, 10 years from now, and that is...
All right, Mr. J. Scott in the flesh, how are you?
How's it going, Brian?
I'm excited to have this conversation today, man. I want to start this off with a quote. That's one of my favorite quotes that I got from one of my 9-figure mentors, which is, every single day that you spend in a bad market or a down market is one day closer to the next good market.
It's true, but there's another way to look at this. Everybody's always, they want a good market. They want things to be great, but here's the thing. What's investing about? It's buying low and selling high. And I know it hurts your brain when things are bad, when the market's down. I mean, I'm in the multifamily space. We've lost 35% over the last couple of years in values in multifamily. And a lot of people are really down. They're like, yeah, I don't want to be investing right now because it just feels like things are so bad. But the reality is, this is the bottom. Mm-hmm. This is the time to be investing. Buy low, sell high. This is low. So if we can get in today and get our heads out of that mindset that things are so bad. Yeah, things are bad today, but they're going to be good in a year or 2 years or 3 years or 5 years. Today's the day to be buying because we're going to look back in 5 years and we're going to wish we bought everything.
I think it's funny because one of my team members, Caitlin, actually sent this to me last night where I'm like, I'm freaking out my business. Like right now we're not in multifamily, but it's just a season of growth. You're in the messy middle. You go through seasons in business. And I was just like, this is so much, you know, like there's so many new things, new situations, new scenarios, new interest rates start being thrown at us with investments. And I don't know how to push through this. And she goes like, your breaking point is God's building point. Yep. And I thought, wow, how funny that we ask for growth. And then the prerequisite to growth is discomfort and friction. Yep. And that's what yields growth. But then we say we want this thing and then we complain and bitch about the friction and the stuff that's associated with it. And that's how I feel about a down market. We're like, oh my God, you know, I want to be a multimillionaire. I want all this equity. I want to build empires. All these companies that have lasted 100 plus years were all founded in recessions. Yeah. And then we're complaining about there being a recession.
Yeah. What I challenge everybody out there to do is try and put aside for a day or a week or even just a couple hours the emotional component. Mm-hmm. Stop thinking about all the things that can go wrong. Stop thinking about all the distress in the market, especially, again, if you're in commercial, if you're in multifamily, things have been really bad for a couple of years, and it's real easy to get up in the morning and just not be motivated and just feel like, why am I doing this? I mean, I've had those mornings where it's just like I have properties that I'm managing that I bought a couple of years ago, and it's just like, I just want this to be done, and I just want to move on. But get past the emotional aspect of it to the intellectual aspect of it. And think back. I mean, if I asked you if you could have bought 100 single-family houses at some point in the past, when would you have bought them?
Like 2011?
2011, just after the Great Recession. If you had a second time to choose, when would it have been? 2020, 2021.
Oh, yeah, pre-COVID, yeah.
Right after COVID.
Yeah.
So, or during COVID or right before COVID. I mean, these are the times to buy, right before these great big economic negative events, or right after these great big economic negative events. Because, again, emotionally, we're drained. We don't want to do it. We just want to go back to sleep and wait for everything to get better. But once things get better, you're sitting there wishing you had taken action. Mm-hmm. And so now's the time to take action because in a couple of years, you're going to look back and wish you did.
Yeah, it's like the fight or flight reflex. Yeah. You know, are you going to, when you get punched in the face, do you back off or do you like lean in and fight back?
Yep.
I love that. So let's give the audience like a little bit of structure for this podcast. What we'll do is first, I'll allow you to introduce yourself and all the investments that you have today for somebody that perhaps is unfamiliar with you and hasn't listened to you prior on this show. Then we will go into what the hell is going on in the market today. What's the economy going on today? Because a lot of people listening and watching this are probably working, a stable 9 to 5 job. They're making a good 6-figure income. They've got some investments on the side. They want to go bigger. And all they're seeing is, oh, okay, I'm hearing about tariffs. I'm hearing about economic uncertainty. My dollar's not going as far today as it used to, and I feel a little bit squeezed and not as secure as I felt before. So let's talk about the economy, which you love talking about, and then we're going to talk about the commercial market in general. So we'll talk about, what you've experienced as an operator, what other operators are experiencing that have the bridge debt, which we'll talk about, and then opportunities for new investors. So let's begin with, who is Jay Scott for people listening, and why should they listen to you about macroeconomics? Because this is your freaking jam, man.
So I'm an engineer by education, spent 15 years in the tech industry, spent most of my career at Microsoft managing businesses there. 2008, moved into real estate. And so I kind of took my knowledge of building, scaling, growing businesses in the tech world into real estate. And so started flipping houses. We flipped out 450 houses between 2008 and 2017. 2018, jumped into multifamily, started buying multifamily, and today we own about 1,100 units around the country, multifamily units, and then about another 100 or so single-family houses around the country. Mm-hmm. So my goal these days is just to acquire and hold as many units as we can, build long-term wealth.
And I remember when you made the specific pivot from house flipping to multifamily. Can you talk a little bit about the pivot before we begin here, from the idea of the generation of active income into wealth building?
Yeah. Let's be clear. What I'm doing now is still active income.
Absolutely.
It's just less transactional. So in the flipping world, you're buying.
Less commoditized.
Exactly. You're buying, 3 months later, 6 months later, you're selling, you're taking that cash and you're moving into something else. What I'm doing today is actually very similar. I'm doing flips, but on a much larger scale. So we're buying 150, 200, 300 unit apartment complexes. We're holding them for 3 years, 5 years, 7 years. We're improving, just like you do a physical renovation on a single family house flip. We're doing physical renovations. We're doing management renovations, because at the end of the day, with commercial real estate, with multifamily real estate, the value of the property is directly related to the amount of income it produces. Mm-hmm. So our goal is spend 3 to 5 years maximizing the income, resell it for a profit. We make money, our investors make money. So what we're doing today is very much still transactional, like a house flip, but the benefits are, one, much better tax benefits. So I paid a lot of taxes between 2008 and 2018 when I was flipping houses.
Can't imagine.
Tax bracket we were in the highest tax bracket. Yeah. We were paying 37, 39, 40%. These days, we haven't paid taxes in 5 years. So long-term buy and hold gives a lot of benefits for tax deferral. We can push off taxes for a number of years. Now, we'll probably eventually have to pay those taxes, but if I can take $200,000, $300,000, $400,000 that I would otherwise be paying the government every year, and I can push off having to pay that for 10 years.
I get
to compound it. So if I can compound $200,000 for 10 years, I'm going to double my money. If I can do that every year, I'm going to start making $200,000 a year extra. And then I pay the taxes somewhere far down the road. So number one, tax benefits was a big reason. Number two, bigger deals are just better deals, in my opinion. House flipping, for anybody that's done it, it's tedious. And there's a lot of overhead involved. There's a lot of management involved.
A lot of variabilities with kind of the worst, like subs and everything.
Exactly.
It's hard.
It's hard. And you're not generating any cash flow while you're holding it. So if something happens to the market, you're screwed. Mm-hmm. The nice thing about commercial, multifamily, larger deals is the hold time is longer. So if I'm planning to hold for 3 years, there's some economic event, we have a recession or whatever, okay, I hold for 5 years instead, or 7 years. I'm generating enough cash flow that I'm not desperate to sell it. I'm actually making money while the market's bad, while I'm holding that asset. So for a lot of reasons, tax benefits, cash flow, just lower risk, financing is better. In the commercial multifamily space. I mean, it's really hard to get single-family loans for house flips. Not a lot of banks want to finance that, so you have to go out to private lenders. Multifamily space, there are government agencies out there that are just desperate to lend money. Non-recourse loans, tens of millions of dollars in non-recourse loans. I mean, you can't get better financing than you can in the commercial and the multifamily space. So for a lot of reasons, it's very similar what we're doing today as what we were doing for the first 10 years with single family, but a lot lower risk, a lot better tax benefits, and a lot more cash flow.
Beautiful. Yeah. I think what most people don't understand about taxes is that if you're making over $100,000 a year, you're basically working for free until mid-May every single year because you're paying that 37% to the U.S. government. And as soon as I thought about it like that, I was like, holy shit, what am I doing without a tax strategy?
Yeah.
Because that's where real estate comes in. And then that's where wealth building comes in.
Yep.
And wealth calculations and wealth and tax, like calculations and tax strategy. If people could understand this, it's literally going to your income and adding 37%
It is.
to your income.
Yep. And
Insanity.
Even when you do pay the taxes, and this could change. I mean, there's a budget bill in Congress right now.
I think it passed. Big, beautiful bill, right?
Yeah, but there's a provision that they're talking about adding, which would get rid of this thing called the carried interest loophole, which is this really nice benefit for real estate investors, especially larger real estate investors, where instead of paying ordinary income taxes, paying 25, 30, 37, 39%, depending on your tax bracket, we get to pay long-term capital gains rates. We pay
It's like 10%.
20%.
Yeah.
And so paying 20% versus 40%, I mean, one, we're pushing off taxes for 5 or 10 or 15 years, but two, when we actually have to pay them, we're paying half as much. And so again, yeah, there's so many benefits that real estate investors get when it comes to taxes, and a lot of us don't think about it early on. We're just so focused on let's make as much money as we can, not focused on how do we save as much of what we're making as we can, and then we get 5, 10, 15 years into the business, and that's when we start thinking about taxes. And I look back and I'm like, if I would have realized how much I could have benefited from tax deferral 15 years ago, I'd have made millions of more dollars.
Yeah, that's where I'm at today. It's like now I started buying businesses and starting businesses, and I was like, ow. I got hit with my first big one this year, and I was just like, got it. Okay, cool. Yep. Back into real estate we go for a bit. It's a combination of the yin and the yang. So talking about taxes, talking about how far a dollar goes, people feel like a dollar doesn't go as far anymore in today's current economy. Yep. So walk us through a little bit at a high level. What exactly is going on, and what are we kind of anticipating with the economy and where we're at right now in like the debt cycle? How does that impact the average person that's working a corporate job right now that's looking to start investing and earn their financial freedom? Yeah,
I think part of the issue we have these days is we haven't had a real recession. I mean, we had 2020 during COVID, but that wasn't a real recession.
We've had manufactured recovery.
Exactly, and it was short-lived, and the recovery was so quick and nice that we barely even noticed it. So
soft landing.
Exactly. Close enough. So the last time we had a real recession was 2008. 2008, 9, 10. So it's been nearly 15 years, 16 years since we've had a recession. If you're in your 20s, you don't remember what it was like to have a recession. If you're in your 30s, you barely remember what it's like to have a recession. Even if you're in your 40s, you were probably in your 20s the last time we had a major recession, and your life was completely different. You were focused on going out, partying, maybe going to college, maybe starting your first job. You weren't thinking about the economy. You weren't thinking about how economics works. So for most people out there today that are in real estate or just in general, they don't remember the last time we had a significant recession. Now, I'm old. I'm in my 50s, and I remember 2008. I also remember 2001. I also remember 1990s, the early 90s, late 80s. And doing some economic research, what you'll learn is recessions aren't these things that only happen every 15 or 20 years and are like 2008. In general, recessions, if you look back through history, we've had 36 recessions over the last 160 years. So you can do the math. 160 divided by 36, we have a recession on average every 4 years. Mm-hmm. And so most people don't realize that. They think recessions are these really big, crazy events where the real estate market drops 30%, unemployment goes to 10%, everybody's struggling, everybody's losing their jobs, everybody's losing their houses, everybody's declaring bankruptcy. But the reality is that's not a typical recession. 2008, it might be the last recession we remember, but that's not the way it normally happens.
Yeah, we have recency bias.
We do have recency bias. And the recency bias isn't just the last recession was so big, it's that we don't even think about recessions anymore. And so when I say to somebody, hey, if somebody says to me, hey, where do you think the economy's heading? I say, we're heading towards a recession. People want to argue with me. No, we're not going to have a recession. Well, the reality is we are going to have a recession. I don't know if it's today, 6 months from now, 5 years from now, But the reality is recessions happen. The economy is cyclical, and on average, we have them every 4, 5, 6, 7 years, and we're now overdue by about a decade.
I think it's funny whenever you talk about recession from a technical perspective versus a felt perspective.
Yeah.
Because if you go to anybody in the middle class right now or lower middle class, they will tell you exactly what we're in. They're like, we've been in a recession.
Yeah.
I feel this. I can barely afford to pay my rent, barely afford to pay my mortgage. People aren't able to sell their houses, which is keeping the inventory like kind of manufactured at a very low rate because nobody can sell their house and move to another house.
Yep.
Because what are they going to do? They're going to buy half a house for the same price as their current one and pay more mortgage.
Yeah. At any given time, there's a segment of the population that's feeling stressed, that's feeling financially down, stressed, not doing well. Oftentimes, it's the lower groups in the socioeconomic spectrum. And that's because wage growth at the lowest levels is low. Minimum wage. How much has minimum wage gone up nationally over the last 30 years?
Correct.
Barely any. But inflation's gone up a lot. So normally it's those at the lowest levels of income that are really being stressed out. Middle class is a little stressed out. Upper class, not stressed out much at all.
Yeah, because they're benefiting from the appreciation.
Exactly. What we've seen over the last couple of years has been a little bit different. Highest levels of income are doing really well. With all the money flowing through the economy, they're generating great returns on their assets. Stock market's going up, real estate's going up, gold's going up, everything's going up. So those who are wealthy that own assets, they're doing great. It turns out that those at the very bottom are actually doing pretty well also. So since COVID, what we've seen is that wage growth at the lowest levels of income have outpaced inflation. So those at the lowest levels, they're still struggling. Don't get me wrong. It's really hard to be working minimum wage. You're working 1, 2, 3 jobs. You're putting in more than 40 hours a week to barely make ends meet. But they're keeping up with inflation. So their lives haven't gotten appreciably worse since COVID.
Correct, yeah.
It's the middle class
that's squeezed.
That's been squeezed for the last few years. And that's because we've seen 21, 22, 23% inflation compounded since COVID, but we haven't seen wage growth at 21, 22, 23%. We've seen wage growth, well, actually it's been about 20, 21, 22%, which means their wages haven't gone up. So if you believe the government's inflation number, basically the middle class hasn't gone anywhere. Reality, government's inflation number is probably low. Things have gone up faster than that, higher than that. And so middle class has actually lost money over the last few years. And so in most recessions, in most economic softening periods, what we see is the middle class does pretty well. The lower classes don't do as well. Over the last few years, it's been just the opposite. And that's why a lot in the middle class are feeling squeezed, feeling like we're in a recession, even though technically, if you look at the data, we're not.
Yeah, so let's talk about tariffs for a little bit and kind of our current economic policies because Trump just took office in January. And then so now what I'm seeing in like kind of the front lines, because we talk to a lot of people that are in corporate jobs, a lot of well-paying corporate jobs. We talk to a lot of engineers, a lot of tech, a lot of sales, a lot of VPs, a lot of ops, engineers of all type, like data, mechanical, software, all of them. We are seeing left and right our members that are making $200,000, $300,000 a year, 9 years in a position, all of a sudden it's gone.
Yep.
And we're seeing mass layoffs across the board.
Yep.
We have AI paired with tariffs. Like now these high paying positions that we're talking about, you know, that are high income earners but not high asset holders, key difference.
Yep.
They are now going from a position of I feel good, I feel safe, I feel secure to now, holy shit, what do I do to protect my family in case I'm one of these next, 10% layoffs at Google or 30% layoffs at Tesla or something like that.
Yep.
So how does AI and how are the tariffs impacting this kind of economic environment? And then we'll go into maybe some advice that we can give for people that are on the front lines of this as they're getting ready to start investing their investing careers.
Yeah. Business owners, large business owners, small business owners, they obviously like when the economy is doing well, when we're in an expansion, when they can buy more inventory, sell more stuff, build more warehouses, build more storefronts, whatever they're doing.
Or widgets.
Build more widgets and sell more widgets. They love that. The thing they don't love, but next in line is when we're in a softening economy and they know things are going down. That's when they do layoffs. That's when they stop selling as much. That's when they close warehouses. They stop building new manufacturing facilities. They stop building new storefronts, whatever it is. The thing that business owners hate the most is uncertainty.
Correct.
They don't like to not know where things are headed, because then they don't know, should I be hiring? Should I be laying off? Should I be building? Should I stop building? What should I be doing? And unfortunately, with tariffs and a lot of other political policy right now, what we're seeing is there's a tremendous amount of uncertainty. Business owners don't know what to expect next week or next month or 6 months from now in terms of tariff policy, in terms of economic policy, in terms of budget policy, budgets coming out of Congress. And so this uncertainty is basically leading business owners to assume the worst and to take drastic action in a negative way that's probably worse than they'd be taking if they just knew we were heading into a regular recession.
I don't want to make this a political podcast,
Sure.
and it's never been and it's never going to be, because I just don't care for politics at all. But I am kind of curious about your perspectives on not the information itself, not the actions themselves, but kind of how they've been portrayed and how they've been executed, right?
Yeah.
So there's one camp on one side of the fence that said, for people that are listening that have no idea about the tariffs, like tariffs are basically the economic lever that we can pull that is a tax on incoming goods from external countries, so that we can incentivize, the United States to domestically produce, because now the cost is way more beneficial within stateside. And so the idea was that Trump is going to do this massive, tariff thing so that he has bargaining power, he has negotiation power. And so he's starting at a huge shock and awe with that 30% tariff that he put on China. And now I believe it's been reduced to 10%? And so now he has bargaining power because people see that he's serious. So there's an argument that can be made that if he had not made such a drastic change in a drastic statement, then he would not have bargaining power. It's kind of his art of the deal, right? The other camp are my friends that are business owners that run 9-figure companies, and all of a sudden, one day they look at the P&L and go, holy shit, are we going to be able to be in business? All of our manufacturing is done in China, and this isn't something that I can do in 2 weeks to remove manufacturing. We see that with Apple flying in freaking Boeing 747s of iPhones like 3 days before the tariffs went into act. So how do you feel about how it's been kind of laid out and how it's been implemented?
Yeah.
And what do you think that they're kind of thinking about that?
Yeah, let me start with the goals are great. Get rid of waste. Get rid of fraud.
Execution is batshit insane from what I'm seeing.
Execution has been absolutely horrendous because the administration, I think, has competing goals. One, they want to make this country better, which is great. Two, less great is, I think, and I'm not even going to say the administration, the president wants to do it very publicly, very loudly, very flashy, and wants to make a big spectacle of it. And the problem is that when you do it that way, you take away a lot of the potential nuance that you could use to negotiate behind the scenes.
In closed doors.
Under closed doors. I'm not saying I'd make a better president than anybody else that's ever been president, but if I were doing this, let's be clear. The U.S. has tremendous leverage over every country on the planet. There's not a single country on this planet that we don't have tremendous economic, military, financial, currency leverage over on the planet.
And the U.S. dollar is still the reserve currency of the world.
It's still the reserve currency. That's not going away anytime soon.
Right.
And so there's not a single other economy or country on this planet that we couldn't, behind closed doors, negotiate better deals. Here's the problem. While we may be more powerful and more leveraged than any other country on the planet, we're not more powerful and more leveraged than all the other countries on the planet combined. And when we start a trade war with every other country, what's their first reaction? Their first reaction is, how do we unite to fight against this common enemy, being the United States at this point? And so now we have countries like China that we are economically more powerful, have more leverage than. Japan, economically more powerful, have more leverage than. India, economically more powerful, have more leverage than. The EU, economically more powerful, have more leverage than. But when these countries and groups of countries start to get together and say, how do we fight back against the U.S.? We're not more powerful or more economically leveraged than all of them together.
Correct.
And that's where we have a lot of risk. And so what we're seeing, and what I think we're going to see over the next couple of years, is a lot of these groups, maybe even not intentionally trying to cut the U.S. out, but for their own self-preservation, are going to start doing trade deals, unilateral trade deals, bilateral trade deals, regional trade deals, where they say, hey, we don't know what the U.S. is going to do next year or 5 years from now, so we can't trust that they're going to be a major trading partner. China's going to say, we need to start building relationships with the EU, even though we haven't had relationships with the EU. We have to start building better relationships with Canada. We have to start building better relationships in the Middle East and in Asia. And so now they're going to have better trading partners. That's going to give them more leverage. They're not going to need us as much. And when all these countries start building all of these additional trade routes and trade agreements with each other, that's going to reduce our leverage. It's also going to reduce the amount of U.S. dollars that are going out to the world, which reduces our currency power. And our currency power is really the most important thing right now. You could say we have the best military in the world. You can say we have the best economy in the world. You can say that we have the best capitalism is the best system of
The best companies in the world.
We have the best companies in the world. We have the most innovation in the world. But really the thing that makes us the most powerful country on the planet is what you said earlier. The U.S. dollar is the world's reserve currency. It's the currency that everybody trades in. And so everybody needs U.S. dollars. And so everybody has to partake in trade and negotiation with us to keep those dollars flowing throughout the world. And so when other countries start to kind of push us out or start doing deals with each other where we become less leveraged and have less power over what's happening in the world, that's going to hurt us long term.
I think that was well said and well positioned. Normally, we're not talking too much about tariffs and everything because a lot of the people on Main Street, like they're like, dude, I just want to go get my paycheck and then figure out how to invest.
Yeah.
You know, but I think that was a very, very good hierarching like overview about like kind of what's going on because people need to know. It's not the sexiest thing to talk about, but they need to have an understanding of what's going on behind the scenes and like what are the main economic levers that are driving things forward, because these are the levers that drive manufacturing, that drive commercial valuations, that can drive, you know, the housing market. It all is just going in that one pyramid like waterfalling down and down and down and down.
Yeah, and what we're thinking of right now is what's the impact of tariffs next week or next month? Are we going to see empty store shelves? Are we going to see higher unemployment? Are we going to see inflation? Those are all important questions. But regardless of what the answers to those short-term questions are, the thing that we're not thinking enough about is that 5, 10, 20 years from now, things are going to be a lot worse because of what we're doing with tariffs today, our uniting of all these other countries against us, or not, again, not necessarily intentionally against us, but uniting all of these other countries together for self-preservation purposes. That's going to hurt us 5, 10, 20 years from now. We're going to look back and say, what's happening today was really not good for our economy long term. Not saying that it can't be fixed. Hopefully it can be fixed in the next 3 years before this administration's done, or the next administration, or the one after that. But the way things are going, we're going to look back in 20 years and realize this was a big mistake, I think.
I agree. So I want to pivot to one like very, very specific question that I hit on a lot and that I really want to internalize myself so that I can best explain it to people, because I think that when you take an idea, a complex idea, and you chew on it and chew on it and chew on it and digest it, and you're able to kind of like now give it to people at a very simple context, the question is bridge debt. So what has been happening in the commercial space over the last, year or two now, because we have bridge debt coming due.
Yep.
Like bridge loans are coming due, and now people are unable to refinance like they anticipated, which I'm sure you're probably in the same boat.
Yep.
So can you describe a little bit about the lay of the land in commercial real estate today, especially when it comes to multifamily, and then we can go into strategies and tips for people that are trying to enter the market for the first time right now and do things the right way, because I can name 100 investors that I know that did things perhaps a bit over leveraged.
Yep.
But I can also, on the other hand, name 100 investors that I know that are badass investors.
Yep.
And they don't know what to do.
Yeah.
So what happened?
Yeah. So let me start with a little bit of backstory about how loans work in the commercial space. Really two types of loans. We have fixed rate debt where basically you take out a loan for, it could be 3 years, 5 years, 10 years, 20 years. We have a deal we're doing now. It's a 40-year fixed rate loan through HUD. And so you have the same interest rate forever. You never have to worry about rates going up. You don't get the benefits of them going down, but you know what you're dealing with from the very beginning. And then secondly, we have these things called floating rate loans. And that's where the interest rate is going to be based on what's going on in the economy. If interest rates for other things go up, the interest rate for your loan is going to go up over time. If interest rate for other things are going down, your interest rate's going to go down. These floating rate loans tend to be shorter term loans. They tend to be 3, 5, 6-year loans. They might be 10 or 12-year loans also, but they tend to be shorter term loans, and we generally get those because we expect that we're going to need that loan for a shorter period of time. And obviously there are risks with floating rate debt, and we saw that in 2022, 2023, when interest rates or mortgage rates went from 3 and 4% up to 6, 7, 8%. And so a lot of us got squeezed because of that. So the first question people might be asking is, why would anybody ever use a floating rate loan? Just get a fixed rate loan and get rid of all your risk. The reason people want to use, or the reason commercial real estate investors typically use floating rate debt, is that there's one big difference between floating rate and fixed rate debt, and that's that there are prepayment penalties on fixed rate debt. So if I go get, let's say I get a 10-year fixed rate loan at 6%, and now on another property, I go get a 10-year floating rate loan at 6%. Somebody might say, well, why would you ever get the floating rate loan? Maybe I think interest rates are coming down, but they could go up. And so why not just lock in that 6% for 10 years? The fixed rate loan is going to have a prepayment penalty. If I pay that loan off prior to 10 years, I'm going to pay a penalty, and it might be a really big penalty. The floating rate loan probably doesn't have that penalty. So if I pay that loan off in 3 years, 4 years, 5 years, the lender's not going to say you have to pay a penalty for paying it off early. Now, people say, okay, so you pay a penalty on the fixed rate loan. No big deal. Well, it is a big deal because a lot of times the penalties on the fixed rate loans, the prepayment penalties, are in the millions of dollars. Literally, a prepayment penalty on a $10 million loan that you pay off in 5 years could be $2 or $3 million.
Wow. Okay.
And so that's going to eat into
20,
your profit.
30% of the deal.
20, 30% of the deal. So if you know that your business plan is to buy a property and sell it in 3 years or 5 years, getting a fixed rate loan for 10 years, you need to factor in that huge prepayment penalty, and that's probably going to reduce your returns enough where the deal may not be worth it. So at that point, you're thinking, okay, there's interest rate risk on the floating rate debt, but I don't have to risk that $2 or $3 million on the back end. Maybe I'm risking $50,000 a month if rates go up. And so you have to kind of play those two risks off and decide which one's the better risk. And so I know a lot of investors, a lot of passive investors who aren't familiar with these loans are looking at operators over the last couple of years and saying, well, why did you get a floating rate loan? That was just stupid. If you were smart, you would have just gotten fixed rate debt. The reality is a lot of these deals that we've done over the last few years just wouldn't have worked with fixed rate debt because we expected them to be 3 or 4 or 5 year projects. And with a 10 or 12 year loan, the prepayment penalty would have just been too large.
Would have been crushing.
Yeah.
Because it's such a slim margin business that 20, 30% would actually put you significantly underwater.
Yeah, exactly.
Okay. So now people take out these floating loans.
Yep.
So, or called bridge loans. And then now they're all due. So everybody that bought in 2021, 2022, which was everybody and their brother and mother and sister and uncle, now here we are today. What happened and why can't they refinance?
So let's say we take out a loan for $10 million on a property that's worth $15 million. The lender says, okay, we'll give you a loan for 2/3 the value of the property. Now, suddenly the interest rate goes up, the cap rate goes up, the value of the property goes down. So that $15 million property is now worth $13 million. Your loan's up. You need to refinance into a new loan. You go to the lender and say, hey, I want to get a new loan. Well, they say, well, we're still willing to give you 66%, 2/3 of the value of the property, but the value is only $13 million now. So your new loan is going to be 2/3 of $13 million, or what's that, $9 million. So instead of the $10 million loan you got the first time around, now they're willing to give you $9 million. So you need to
bring up $1 million.
You need to come to the table with $1 million
cash
to refinance into this new loan. Where do you get that $1 million from?
You have to do a capital call.
You can do a capital call. So you tell your investors, hey, I want to refinance into a new loan. It's going to cost us $1 million. We need you to give us more money. And so that's why we've seen so many capital calls over the last couple of years. It's because all of these loans are coming due. We want to refinance. Properties are worth less. Lenders are willing to lend less. And so to do these refinances, we need to bring capital to the table. And so we need to do a capital call. So that's been one of the big problems. There's another thing called rate caps. This has been a big issue that's not talked a lot about in the industry. But basically when we get a floating rate loan, so let's say interest rates in 2021 when we got a loan were 4%. And so the lender says, okay, we're lending you floating rate 4%. If rates go up, obviously you're going to pay more. But we don't want to risk you ever having to pay more than 6%. Because that would put the property in a really bad position. So we're going to require you to buy this insurance policy. We call them a rate cap insurance policy, which says if rates go higher than 6%, the insurance company is going to pay the overage.
Premium.
So you're going to go from 4 to 6%, and then the insurance company is going to pay the rest. And so now you never have to worry about paying more than 6%. Your rate can go up to 6%, but you never have to worry about paying more. And you're going to pay a premium for that insurance policy. In 2022, we got one of those policies for one of our properties. It was $30,000 per year. And the lender said, you have to get this because we don't ever want to take a risk of you having to pay more than 6%. So we factored that $30,000 per year into our pro forma, into our operating budget, and all the numbers worked. That was a 3-year policy. We figured we'd sell the property after 3 years, so it wasn't an issue. 3 years went by. We get into 2020. This was actually 2020 when we bought this property. We get into 2023, and now that 3-year policy is up. The lender says, well, you need a new policy because we still don't want you to take any rate risk. And so we go to the insurance company and we say, hey, we need a new rate cap insurance policy. And they say, great, we're happy to give it to you, the same terms, but because interest rates have gone up, because there's so much volatility in the market, we now are going to charge you $550,000.
What the hell?
Per year for this insurance policy. And this is a real example. This is one of our properties.
From $30,000 to $550,000?
$30,000 to $550,000.
How's that not criminal?
It's an insurance policy. And so that's them covering their risk. And so we saw a lot of operators who had these policies that went into the millions of dollars. And so at that point, now not only are we paying more, but now we have less cash flow. Our DSCR is lower, so the bank's looking at the property and saying, hey, can you afford to even hold this property any longer? Should we be thinking about foreclosing? And so now our options are, one, we can refinance into a fixed rate loan. But at this point, we're getting ready to sell the property. We think we're going to sell the property in a year or two. So if we get a fixed rate loan for 5 or 10 years, we're going to pay a huge prepayment penalty if we sell it in a couple of years. Rates have gone up. So that fixed rate is probably going to be higher than the 6% that we're capped at in the past with that insurance policy. So there's a lot of different dynamics going on here. And so rate caps have been one of the other things that have been driving a lot of operators struggling over the last couple of years because they had this great project, this great loan product, this great insurance policy, but then when the insurance policy renews, they're suddenly paying hundreds of thousands of dollars more per year. That's reducing the cash flow, and now suddenly investors are getting no distributions, maybe even having to do capital calls just to keep the project from going under.
On top of insurance, just from like a general perspective, especially in any tropical locations or any freaking like Louisiana, Florida, anything like that is absolutely bananas. Like those premiums have increased like 400%.
Yeah, I mean, it was great during 2020, 2021 when rents were going up 5, 6, 7% in most markets. And expenses were also going up 3, 4, 5%, but we were making more money because rents were going up faster than expenses. 2023 comes around and suddenly expenses with inflation, we had 9% inflation at one point. So expenses are going up 5, 6, 7% a year. Rents are now going up 1, 2, 3% a year because we're not seeing the rent growth that we were seeing. And so now suddenly expenses are going up faster than rents, and we're getting squeezed there as well. So lots of issues in the multifamily market over the last couple of years.
So where do we go from here? So you're saying all of this kind of with a smile as somebody that, I mean, I view you as like one of my favorite investors, that you're very risk averse, you're very conservative, like you're one of the ones I feel do it right. But then again, I also have a lot of friends that also like did it right. Like they underwrote conservatively. They really try to do right by their investors, and now they're really squeezed. So I guess the question is, you know, kind of twofold. Like one, what's a multifamily investor to do right now
Yeah.
in this market with this happening, because it's happening to the majority of people. I can't honestly name one person that has raised a significant fund that isn't feeling the pressure and feeling the squeeze right now.
Yeah.
So what are they to do? What are you guys to do? Like, what's the game plan to get out of this
Yeah.
unscathed, or at least like with a few bumps and bruises so you can live to fight another day? And then the other side of the question is, somebody right now is like, hey, I've got a few single family and I want to enter multifamily. I want to enter storage. I want to enter mobile home. I want to enter these commercial properties. Like, how can they, should they be thinking about doing this a different time? Or is there just a different strategy that they can utilize to do this more safely?
Yeah. So starting with the first group, if you bought a property back in 2019, 2021, 2022, and you're getting squeezed, and we have several properties in that category. We were
Sure, 1,100 units.
Yeah, and we were fortunate. We were conservative. Most of our loans were long-term fixed rate, so we didn't have that risk.
You were underwriting for 8-year holds, weren't
We
you?
were underwriting for, well, what we would do is we would run multiple scenarios, and this is what I recommend investors do today. You have your primary exit strategy, which might be to exit in 3, 4, 5 years, but then you need a backup exit strategy. What happens if the economy turns or interest rates go up or the market collapses in that 3 or 4 or 5 years that you're planning to hold it, and now you have to hold it for 10 years? What changes? Can you still cash flow for 10 years? Is your loan going to go out 10 years? Are your investors going to be okay with 10 years? And you run multiple scenarios. So luckily we did that. And so for even the properties that we were expecting to only hold for 3 or 5 years, we ran 8 to 10 year hold scenarios. And we knew that for every property, even if interest rates went up, even if we had to refinance our debt, we knew that we'd be in a position that we could execute on plan B.
How many exit plans do you recommend? You recommend having to plan A, B, C, or how many is overkill?
Generally just 2.
Okay.
And so you might run different scenarios within each of those plans. So there might be a 3-year plan and an 8-year plan. And then there's in the 3-year plan, what if interest rates go up? What if interest rates go down? What if cap rates go up? What if cap rates go down? What if expenses go up? What if rents go down? And then you do the same thing for the 8-year. So it might be multiple iterations of the 2 plans. But generally speaking, you want 2 different time frame exit strategies because that's what we're most sensitive to. So again, the economy works in cycles. And so we don't know, we might plan to sell in 3 years, but we don't know if the economy is just going to collapse in 3 years. We're going to get into a 2008 type event, and we're going to have to hold it for an extra 5 years. So those are the 2 major things, or that's the one major thing that we're looking for is time frame. And then again, within each of those time frames, we're running different scenarios on things like interest rates, cap rates, expenses, rents, things like that.
So what's some advice that you would give to an investor that is looking to enter the commercial space today? Because, this is my bread and butter, is this is the person that we talk to, and we really want to be able to guide them in a position where it's I'm almost glad that we didn't start what we were doing in 2019, 2020. We started Action Academy in 2023.
Yep.
And so I'm almost it's like a godsend that we kind of started it there before people got too sophisticated and started making massive swings for their first couple of deals. So what's some advice you could give to a beginning level or intermediate level commercial investor to kind of, maximize for the upside swings and potential benefits to kind of benefit off the distress today, but also kind of make sure that there's a floor to their downside risk to make sure that their downside risk is capped?
Yeah. So let's be clear, your downside risk is never going to be capped.
Completely.
The risk is always going to be you could lose all of your investors' money. You could lose any money you put into a deal. Don't ever forget that. And I think it's important that not only do we not forget that, but our investors know that because we don't like to surprise our investors. And investors need to know that risk comes with these deals. I hope I never lose $1 of investor money, but all of my investors know that that is a risk. There are things that are outside of our control. There are things that we just can't underwrite for or things that can happen that are so far to the extreme that they just don't make sense to put in our underwriting. So always keep in mind that you're never going to cap that downside risk except at the very losing everything.
Zero.
Zero.
Or negative.
Exactly. And so that's number one. But let me start with the good news. A lot of investors are concerned that the market is still going down. We haven't hit bottom.
Catching a falling knife.
The nice thing in the multifamily space, I don't want to speak for other asset classes in commercial because every asset class is kind of in its own cycle. But for multifamily, what we saw was that we saw a boom after COVID. So 2020, 2021, beginning of 2022, values went through the roof. cap rates compressed, rents went up, everything was looking great. March of 2022, interest rates started to go up, and it only took about 4 months for the multifamily market to drop 25% in value. So it was a really quick, really significant drop in values in multifamily. By the end of the summer of 2022, we were down again 25%. Over the last 3 years, since summer of 2022, we've probably dropped another 5%, maybe another 10%. But for the most part,
it's more stabilized.
It's been more stabilized. For 3 years, we've kind of been bouncing along the bottom again, maybe down a little bit, but bouncing along the bottom. Mm-hmm. And so there's reason to believe, and there's no guarantees in life, but there's reason to believe that we've probably hit substantially the bottom of the multifamily market. We don't know if it's going to go up really slowly. Again, we've been here for 3 years. It could be another 3 years before it goes up. But there's reason to believe that it's probably not going to drop significantly more. So if you're looking to buy in at the bottom, and again, I don't know how quickly it's going to recover, but if you're looking to buy in at the bottom, this is probably pretty close. Mm-hmm. And so now is actually a good time to be looking at deals. There aren't a lot of deals out there simply because a lot of sellers aren't willing to sell. Sellers don't like to sell at the bottom unless they absolutely have to. And banks have been somewhat forgiving over the last couple of years. They haven't forced sellers to sell. Mm-hmm. So we're not seeing a lot of deals out there, but I suspect in the next year or so, we're going to start to see more deals. We're going to start to see more opportunity. And I think it's going to be a good opportunity for newer investors or seasoned investors to be buying at what is probably pretty close to the bottom. The hard part that we're going to be facing is that there are a lot of jaded investors out there, passive investors, LPs. Mm-hmm. And so it's going to be very difficult, or it has been very difficult, to raise capital. So what I would recommend to anybody that wants to buy in the near future, if you're planning to raise capital from passive investors, you have to start building those relationships now. Mm-hmm. And you have to start educating your investors on why the bottom of the market is the right place to buy and not the wrong place to buy, because there are a lot of investors out there that are just they're getting capital calls, they're losing money, they're not seeing distributions, and they're like, I just want to sit back and wait. And by the time they get back in, again, we're gonna be at the top of the market again. And so we need to be educating our investors that now is not as risky as it might seem. Again, always be reasonable and honest about risks, but now is probably the least risky time to be investing in multifamily than we've seen in the last 3 years.
Yeah, and if you want to zoom out to a long enough time horizon, which is real estate, is business, is investing, is like, are we in the macro investing in the proper things? And multifamily is, I think, across the board, if you ask 100 people, do you think multifamily real estate is going anywhere? Like 100 people out of 100 people would say, no, there's only going to be more of it. Yeah. We're moving into a more and more of a renter economy. And as interest rates with the housing market and the housing market increases, it becomes increasingly more so difficult for us to go from a nation of ownership now to a renter's nation. Yeah. And that's just where it's going. It's not going to change. Like, I rent. I love it. Mm-hmm. I pay 50% what I would pay to own in my condo. My condo is listed for $1.5 million. I pay $6,000. Yep. So if I was to have a mortgage on that, I'd have to put $300,000 down, and I'd be paying $11,000 a month. Yep. With that $300,000 down.
I rented till I was 38 years old. If I didn't have kids right now, and when my kids go off to college, we'll be renting again. So there's a lot of advantages to renting. Here's the other thing. So that's the demand side. You talked about the demand side, that it's
only increasing.
It's only increasing. We have more. Hopefully, we have continued population growth in this country. We have more household formations. More people are moving out from their parents' house. They're moving out from their roommate situations, and they're looking to get their own place, whether it's a rental or their own home. So there's going to be continued demand. But there's also the supply side, and the supply side is looking really good as well. We have, at this point, about 5.5 million of undersupplied units in this country, meaning there are about 5 or 5.5 million people out there that would love to be moving out from their parents' house or from their brother's house or from the roommate situation and into their own place. So there's a lot of demand and undersupply there. But two, especially in the multifamily space, it takes 18 to 24 months to build a multifamily property. So we know 18 to 24 months in advance how much supply is coming on the market, because we can see how many builders have pulled permits, how many builders have actually broken ground. And what we're seeing is we're at a low point for the last several years on the number of permits that have been pulled and the amount of properties that are projects that are breaking ground. So we know that over the next 18 to 24 months, we're going to see significantly fewer number of units delivered provided to the demand than we've seen over the last couple of years. So not only do we have high demand, over the next couple of years we're going to have low supply, and that's going to provide a tremendous opportunity for anybody entering the market.
Yeah, and to kind of end this conversation, like now I like this like good trend that we're kind of going on here. So I also went to a like economic event. So like actual, not an economic event from like Tariffs or AI, but like I went to a Tony Robbins event where we had the average net worth in the room was about 16 million to $1 billion, and average like income was $1 million plus. So it was a sophisticated room, and everyone was talking about this type of stuff. And we were talking a lot about macroeconomics, what we were seeing in the economy, what we're seeing in investment classes. And the top investment classes that were discussed were multifamily still. For some reason, they loved horizontal multifamily, like almost like the BTR, like the build to rent. They loved it. So that's something that they were looking at. Residential.
People like to own houses for a reason. They like their space. They like their yard. They like to feel like they're self-sufficient. So if we can give them that feeling in a
with the benefit of the rent, it's a home run strategy. They loved residential assisted living. That's another big one that they really liked. And at the end of the day, when we were looking at macroeconomics, like we've talked a lot about, kind of the issues and the doom and gloom. But at the end of the day, there was a huge debate and discussion about, American superiority and American supremacy in the macroeconomic climate. And what we were talking about was that no matter what, China and Japan in the Asian market, they are below the replacement rate dramatically, and even more so than the reporting, because how they report, apparently, like the leadership just doesn't like to report on some of the data that makes them look bad. So they just told them to stop reporting to them. And so right now, like China's replacement rate is below. So their working force economy is about to plummet. Same as Japan's, like their economy is aging out. And so we have all of this stuff about China like overtaking us, but our replacement rate, we're a little bit beneath right now, but we're actually like the millennials are actually taking over right now. We're very, very strong. So we're in a great position macroeconomically. So basically the thesis statement of the entire event was things are bad, but they're worse everywhere else than they are in the U.S.
And let me just point out, not to make this political, but from an economic standpoint, this is why immigration is so important. And we can argue, we're talking legal immigration and why we should have as much legal immigration as possible, because at the end of the day, population growth is what drives economic activity and economic growth. And any country that's seeing negative population growth, that's seeing negative replacement rate, is going long-term, is going to see an economy that suffers and potentially goes away. I mean, we saw it with Japan back in the 90s. We're seeing it with China now. They had their one-child policy that resulted in very low population growth, and those kids are growing up and they're starting to go to work, and there's not enough of them to fill these jobs. And so, this is why it's so important in this country that we continue to see population growth, because it will determine whether we maintain the superior economy in the world.
In closing advice for somebody that has a few single family, they've got that good paying job, and now they're really looking to become that sophisticated investor and make financial moves and financial investments now that will set and gear their family up for success and freedom in the future. What's some closing advice you would give them in this economy?
We don't know what's going to happen 6 months from now. We don't know what's going to happen 12 months from now. We don't know what's going to happen 2 years from now. But if history is any indication, we know what's going to happen 5 years from now, 7 years from now, 10 years from now. And that is that real estate's going to go up in value. And it's probably going to go up in value tremendously. So don't think in terms of 6 or 12 or 24 months. Think in terms of 5 or 7 or 10 years. And how do you do that? You focus on the larger projects that are going to cash flow while you're holding them. And you model them so that if you have to hold them for longer, they make you more money because they're generating more cash flow. So focus on projects that are, again, 5, 7, 10-year projects, not the single-family flips that you're doing in 3 or 6 months that could get you in a bad situation if the market were to drop. And so I think this is just a great opportunity for those who are looking to get into these larger and longer-term deals. Now's the time to do it, because with all this uncertainty, we should be thinking longer-term for every deal that we're doing.
Beautiful. Jay, where can people find you if they want to learn more? And also, I want to also personally plug your Facebook of all places and your newsletter. You're one of the best economics writers that I've seen. And I think that a lot of people would echo that. And if I was you, I'd take that even more seriously than you do. you're wonderful at it. I love reading everything that you have to say. So where can people find more?
I appreciate that. So if you want links to everything I do, jscott.com, the letter J, SCOTT.com. And then if you want to follow me on social media, JScottInvestor, pretty much every social media.
Beautiful. Jay, thank you so much for coming on, man.
Hey, thanks for having me.
I love seeing you win.
Appreciate it.
Crush it. Thank you, guys. It's been Brian and Jay with the Action Academy podcast. Go make some investments. Make some money. See ya.